let's start with the Turkish lira, right? Not sure, how many of you are trading emerging markets, okay? Not sure how many of you are trading emerging markets, but I thought this was quite a relevant snapshot to take, and just to see how political risk can impact a currency, okay? How it's impacting its economy. We've got Erdogan, who PM over in Turkey. Now, the stance that the government has taken is a very strong stance in their monetary policy. So they have a strong control in regards to what takes place from a monetary standpoint and from their central banker standpoint. So the central bankers have less meaning, and that's been for some time. So they're just more, we can almost say yes men to Erdogan, who leads what takes place in regards to the currency. And that's why the Turkish lira, similar to the South African rand, who is also quite heavily impacted by President Zuma, we see this happening with the Turkish lira as well. So this gives you a quick snapshot of the Turkish lira, of where it is from a multi-year perspective. It's in multi-year lows, so much so it also sort of dived substantially last week. And this picture here just showing that larger sort of picture view of what's taken place. So in 2013, starts off with a taper tantrum, but that was across the world, right? So that taper tantrum started in the US, and there was just a ripple effect across the board with most currencies. So yeah, so the taper tantrum sends emerging markets into that tailspin. Central Bank Governor Baski indicates no plans for interest rates hike. And then you've got sort of, there's a failed coup that had taken place in late 2015, early 2016. Erdogan wins referendum to transform Turkey into an executive presidency. And then this continues on. We've also had US sanctions taking place in the likes of sort of 2018, and then going into sort of 2019, 2020, you've got regulators slashing Turkish banks' FX transactions. We've had resignations taking place from the central bank chief. We've also had a new governor, the O1 being ousted. Central bank delivers a surprise 100 basis points cut. Erdogan swaps 3 MPC members, clearing way for more cuts. So, this is all simulated how Erdogan's view is. And now what his perspective is, he does want to weaken the Turkish lira. And he's done that substantially, as you can already see, right? So he's cut it, he did cut rates, I believe, sort of, late 2020. Middle of 2021, he cut it first by 100 basis points, then another 200 basis points, then most recently another 100 basis points. So that's 400 basis points in total, 4% in total of a rate cut. And that's just snowdived in regards to the Turkish lira. Now, what he wants to do is he wants to weaken the currency, and therefore for trade, it's actually good. Okay, so for trade, it's actually good. Weaker currency is good for them. But this was one of the highlights from last week and what we had seen in the first part of last week. So not towards the end. We know what happened towards the end. We'll discuss that as we go along. But that was the first sort of key pivotal point from last week, starting out Monday and Tuesday. Moving on from there. Now, this is an important stat to have now. Now, I think it was mid last week, we had it confirmed that Joe Biden, President of the United States, has renominated Jerome Powell. He's renominated Jerome Powell for his second term. And this just shows us a quick overview in regards to other Fed chairs and in regards to their, whilst they've been as a chair of the Fed, what has taken place in the markets? Has it been positive? Has it been negative? Most of it has been positive all the way through if you look at each member here. But how positive has it been? Jerome Powell, with only one term under his belt, Dow Jones return based on Fed share, 40% return so far over the 4-year period. Okay, so over that 4-year period, he's achieved sort of a 40% return. There's been others like Paul Volcker, 212%, Alan Greenspan towards the end there, 312%. But these guys were in place for multiple terms. Okay, there were multiple terms. Janet Yellen, I believe she only did 1 term also. So in 1 term, she had achieved 63%. But I believe her term was extended for a short period of time for some reason. I can't remember why, but there was a reason behind that. So this just shows you sort of, how Jerome Powell fares amongst all other chair members in the past. Now, this sort of breaks it down a little bit further. I may need to sort of just make myself minute. Could do that. There we are. So just looking at the stocks have done well with Jerome Powell at the Fed and Dow's performance under various Federal Reserve chair members. Jerome Powell at the bottom there, length in office, we've got 3.8. So it's not quite at that 4-year sort of, end yet. So be renominated from Jan onwards. But yeah, you can see sort of like 40% return there, 40% return. And then you can have it based on an annualized view as well. So this is sort of, Dow annualized return. So what's the average over that 4-year term of what he's achieved? 9.3%. Janet Yellen, I think she did just over 4 years. Dow return 62.6%. Annualized return 12.9%. I mean, the only negative here is Eugene Mayer. Again, if I just have a quick look through. So the 2 that I'm or 3 that I'm quite strongly sort of aware of is Ben Bernanke, Alan Greenspan, and Paul Volcker. Okay, so you can see how Alan Greenspan had done 18.85 sort of years in office. Okay, and that's why he's achieved that incredible 312% return. But that's annualized 8%. So far, Jerome Powell has succeeded Alan Greenspan for the short term. Paul Volcker did 2 terms, but achieved 211% with an average annual return of 15%. Okay, and this was sort of in the latter years of that. When we come, so we had a significant sort of inflationary period between 1972 up to about 1979. So thereafter, things were sort of on the brighter side of things, to be fair, of those 2 terms. Ben Bernanke, sort of 44% return, 4.7% on average annually. So yeah, just a sort of a quick overview of how Fed members have fared. Okay, so we know he's going to be renominated from Jan onwards. He'll be doing his 2nd term. Okay, let's move on there. Okay, moving on. So as we come to the end of the week, we had last week Thursday and Friday. Thursday being Thanksgiving, so there was a decline in the liquidity in the markets because of the holiday, the US holiday, right, the Thanksgiving holiday, as they'll be mostly offline. Now, with that taking place, right, so there's low liquidity in the markets, that could sometimes lead to exaggerated moves taking place. Okay, and exaggerated moves taking place will mean that, okay, if there is a specific shock or a surprise factor that comes to light, all of a sudden you see a large amounts of moves occurring in the markets because of the environment that you're in during that holiday break. Do you remember 40% of the volume comes in based from the US? So, we all know of the Omicron sort of new variant, COVID-19 variant. Now, we're not going to know too much about this. I'll probably touch on this a little bit later towards the end, but the shock of this new Omicron variant, which may be more transmissible, maybe more deadlier, had come out of South Africa, and we'd seen it already get out there, right? So it's already got a wide outreach. There's cases in the UK, Scotland, Netherlands, even Hong Kong have reported cases, and the US, I believe. So there are cases already spreading of this new variant, but there's very little information that's taking place. There's very little information taking place. So this is a snapshot of Friday morning, the UK markets only. So this is for the UK markets only. Exactly how the markets opened. Okay, so the first hour and a half of the UK market being open, we saw all of a sudden a significant amount of panic taking place in the markets. Okay, so there's a substantial amount of panic in the markets. A lot of fear had taken place, and you could see that in your top 10 FTSE risers and the fallers. Okay, so now with COVID being such a concern, what sectors from the stock market is going to be impacted the most? Well, travel, leisure types of sort of, are your ones that are likely to sort of go down. So we saw Carnival, right? Carnival, TUI, Rolls-Royce, EasyJet, IAG, Intercontinental Hotels Group, BP, with an oil sort of correlation there. So all these sort of equity markets or equity corporations that had been largely driven lower, not based on fundamentals, not based on current price to earn ratios or earning reports or anything like that. It's based on how detrimental is this new variant to this company in the next 3-6 months. Okay, and that's what's being priced in now. So yeah, so at the same time, look how sector rotation works, right? So there'll be assets that are seen as risk off in this sort of framework around COVID variants. There will be other assets that would outperform. Now, do note that when you have markets tend to fall quicker than they rise. Okay, so you'll see a lot more selling pressure coming in, where their Carnival achieved nearly 15%. It was down 15%, if not more, on the morning of Friday open, whereas Ocado Group was up 3.12%. Okay, so it wasn't up substantially, but investors would have been bullish. They would have been bullish with supermarkets. They would have been bullish with those home delivery of these groceries types of stocks there as well. So consumer staples and discretionary sort of sectors would have outperformed. So this gives you sort of a quick view of what had taken place Friday morning. Now, looking at the US markets, well, as you can see, it's a sea of red. Okay, across the board, everything was down. Every asset was down. Now, this was taken, there's no precise time, but this was taken quite close to the market open. You can already see Apple, one of the biggest companies out there within the Dow Jones and the S&P 500, is down 2.36%. Microsoft was down 0.75%. Google's down. Facebook, Amazon, Tesla. I mean, you can look across sort of all the sort of sectors. The only sector where it showed a little bit of glimpse of hope was, of course, healthcare. So healthcare was performing much better, right? Okay, so this gives you a good sort of view of what had taken place on Friday. Okay, so what was the outcome of Friday's panic? Well, we can touch on that. So there's this new Omicron sort of variant that's completely new, come out of South Africa. It's seen as potentially more deadly and more transmissible. Cases have already grown globally. Okay. Now the question is, are we in better hands than we were previously? I think so, right? We have already a number of vaccines, right, by different pharmaceutical companies. They can easily adjust those properties within their vaccines. And even though recently we just had CEO of Moderna stating that this virus is probably more deadly, with actually no confirmation behind this. But I think we now have to sort of transition and wait till for the next 2 to 3 weeks, where the WHO will give us further guidance in regards to how bad is this new variant. Okay, how bad is this new variant? And then in these next 2 to 3 weeks, we're going to see more choppy, more volatility taking place. Now, as traders, that's fantastic. So let's go through some of the ideas in regards to how to manage yourself through the upcoming next couple of weeks. So, how do you react? How do you react, right? So from Friday's panic sell-off, for going forward, if we hear more news around the Omicron sort of variant, how can we minimize or use this as a way of making profits, right? Well, as traders, now this is taking the view of a trader, someone who's very short-term in the markets, looking at short-term movements taking place, going to be in and out positions within a few hours, maybe up to the end of the day, but I'll be just very mindful of different sessions. Okay, so London session may lead to a different outcome to the US session, for example, in the afternoon. So just be mindful of how sessions may change according to the news flow and the way those market participants view that news flow as well that comes through. So traders, well, this is what I did, right? This is what I did on Friday. This was my exact process on Friday. First, I went through all my open positions. Any open positions I had, I would either look to protect those gains or minimize my losses, right? And there's three ways you could do that. The first is you can hedge your position. So if you're in a if you're in a long position with a risk on asset and it's risk off environment, that asset is going to go down, it's going to go against you, whatever the profit might be. What you might do is take an inverse position just to sort of protect the profits you've made in that trade. Okay, so that's one way you can go about that, right? If you believe that still trade is going to be on going forward, it's more of a swing trade or a position trade, and you want to sort of minimize the potential losses, you could take a short-term hedged position to sort of lock in some of the gains there, so you minimize the downside overall. So that's one way of minimizing that risk there. Second is any positions that you see are in losses or in quite a bit of losses close to your stop loss, I'll look to close them. There's no point hedging them. There's no point sitting on them, right? The market when markets sell off, it's gonna really sell off. It's just gonna you're gonna see algorithms jumping in on the bandwagon. You see larger moves occurring, larger corrections occurring. So it's pointless if the market's already gone against you. It's now potentially close to your stop loss. Why hold into the position? Don't even think of hedging it. Close the position. Cut your losses quickly. It's a well-known quotation used in the market by traders. Okay, let your winners run, cut your losses quickly. So cut those positions, cut those losses. Something that's going in your favor, and maybe say a risk off asset. It's a risk off asset that you've taken a trade in, and it's now even going further in your favor, right? There could be a very sharp pullback that may occur in the markets, right, later on in the session, because of the exaggerated move. So don't lose out on those profits, right? Start adjusting the stop loss and try and lock in as much of those profits as you can, because that's a fantastic opportunity to sort of maximize the gains, not allowing it to go substantially in your favor, and all of a sudden you see your P&Ls jumped up significantly, your profits jumped up significantly, but it's an open position. It's still an open position. You haven't booked those profits, and that's why you want to trade stop loss as aggressively as you can, lock in as much of the profits, and then just look to re-enter maybe when markets are a little bit more calmer. So those are the three sort of key points I would stress when you have an open position on from maybe overnight for the last few days, or you're taken early on in the morning, and all of a sudden you see panic setting into the markets, right? Now, that covers all your open positions. Now let's focus on, okay, what's happening now, and can I take advantage of the situation ahead? And in order to do that, well, you need to sort of look for trading opportunities, right? So in times of panic and that selling pressure that might take place, you're looking to allocate your position sizing or your positions into the right assets based on the risk-off factors, right? But also they need to be confirmed by the technicals as well. Technicals are extremely important because that's how you can really get good reward to risk ratio trades, right? So that's one way to allocate your positions into risk-off factors, sort of assets, risk-off assets. The other option is to, go into sectors that are more defensive. Now the difference here is risk-off traders or risk-off sort of assets are more macro assets, whereas sector and defensive focus is more I wouldn't say microeconomics, but there is where it's more for equity traders who have a great understanding of correlations and volatility and how sectors have an impact on each other during sort of these times. So to give an example of both, for risk-off assets to buy, okay, and this is to buy, meaning you're looking to go long, okay. So you look at USD, right? Greenback, it's the global reserve currency, right? Most individuals, most traders are going to go back to the USD. Yeah. Generally, we've seen a lot more of the yen and the Swiss franc being safe haven currencies. Okay, so you'll see individuals going to US dollar, the yen, or the Swiss franc out of all the currencies. Yeah. Gold, precious metals overall, right? Precious metals overall. So gold, silver, just focusing on gold. Gold is what I had taken long on Friday morning. Friday morning, I'd got into a long position in gold. Yeah, so gold is another option. Bonds, if you have access to bonds, okay. I don't trade bonds particularly, and it's not one of my 12 assets that I look at. But I have it in front of me, right? I know where sort of the, not bond, but the yield is. I know where the interest rates are for the 10-year bond, and I look at that. But I don't trade it. That's just as a gauge. I use it as an indicator. But you can look at trading, buying bonds. So naturally, when you're going to see yields fall, that means bond prices are rising. Okay, the demand for bonds are rising. So bonds will rise, yields will fall. And in regards to allocating to sectors, you probably saw this in the previous image in regards to the US markets, how healthcare, right, pharmaceutical companies had outperformed where everything else was red. Okay, now that's another area that you could look into, right? Look into assets that you want to buy up based around the current situation, right? Being COVID, healthcare, and pharma would have been in focus. Now, that's one way of buying into assets when there is a risk off environment. But the profit is in the shorts of those risk off trades, right? So it's when there's a risk off environment, you want to go with momentum. Yeah, your short-term traders are momentum traders. You're trading in the direction of the market view, right? You're trading in the direction where the market's going, right? If it's going down, you don't want to be just buying assets that are okay and go up by 1% or 2% or 3%. When markets are falling, you want to take advantage of that 50%, 15% fall, right? So therefore, going short is a great option, and it's definitely something that you should look to consider doing, especially in a risk-off environment. Well, now, oil had sold off substantially, right? So oil did sell off quite substantially. So looking back on Friday, where oil had opened, the open price was 78, pretty much 78 spot, right? So 78 spot, and it went down to a low of 67.38, okay? 67.38. Just looking at a percentage of that, so that is a 13.5% sell-off. 13.5% sell-off in oil. Now, why oil? Well, I thought oil was one of the best trades from Friday, and that's largely due to there's been a lot of recent rhetoric from the US and then grouped together other countries such as India to release production of oils that they've been storing. Okay, so there was that sort of fundamental being released at the same time we had OPEC Plus, who were looking to increase the production, but not to a significant amount. I think it was around 400,000 barrels per day per month. And yeah, so we're now seeing, obviously, with COVID, there's going to be maybe restrictions, there may be less travel, and that's all going to have an impact in the demand for oil. Okay, and so much so, this upcoming week is where we're supposed to have a OPEC Plus meeting, and now that may have been postponed so that these guys can sort of review what's taking place in the markets, what should we do, right? Now there's discussions potentially, or these markets are pricing in that they may reduce the production levels in the next couple of months to comprehend sort of any further outcomes from this new Omicron variant, right? So yeah, so going short in oil would have been a great option. As we've seen, sort of the equity markets as a whole had sold off substantially, right? So just equity markets as a whole had also fallen. And just having a quick look through maybe if we look at the S&P 500 on Friday, it was at a high of 47.10 with a low of 45.81. So in percentage, let me just take the percentage there to this point of a hair, it's 2.7%. Okay, so 2.7% sell-off. Not a huge amount in comparison to oil, right? And that was the trade of the day, to be honest. But yeah, again, you know, if you just look at the candle itself, it opened and it closed with a very strong sort of bullish engulfing candle. You know, so it's a almost a Marabuzu candle. I see a very small spike to the low and to the high. It is a strong Marabuzu candle. So yeah, it's a strong sell-off day in regards to sort of equity markets as well. So that's your option as a trader. Right? These are sort of, you know, gives you a view as a trader. Guys, are you able to, I know you can't see my graph. I know I'm just going through the percentages and the highs and lows as well. I'm still staying on the PowerPoint. We'll have a look at the charts once I'm completed the PowerPoint presentation. Okay, now how do you react as a portfolio manager or investor? Okay, how would you sort of, you know, trade and deploy, you know, the tools that you have and the knowledge that you've developed when, you know, in times of risk off, all of a sudden you see a panic sell-off where the Dow Jones is down nearly 900 points. What do you do? Well, you know, the first thing I want to ask you to ask yourself is, did you buy shares with a short-term view in regards to the holding period? So that's what you're going to do, is have a look at the trade I've taken, right? If I've taken a position, whatever it might be, am I holding this trade for the next, you know, few days or a few hours? Then yeah, you might want to react, you might want to do something, right? But if I'm holding a trade I'm looking to hold for maybe a couple of weeks, maybe even a few months, right? Or longer, why would I want to react based on that information, right? That's not what you want to do. Don't react, right? Don't panic, okay? It's Warren Buffett who says, in the markets, it's the impatient that tends to give their money to the most patient. Okay, so be patient, relax. No, don't panic and don't get, you know, feared at the market. Okay, so you know that fear. There's two things that will happen in the markets. You're either going to be greedy or you're going to be fearful, and that fear is when what we saw on Friday. Don't let that impact you. As I've already mentioned, the markets, I believe, had overreacted, and that's been confirmed when we saw yesterday a little bit of a correction occurring. Okay, markets decided to bid up those prices. Okay, so you know, the markets had over exaggerated, and that was largely due to that thin liquidity I spoke about with the US holiday, the Thanksgiving holiday on Thursday and Friday. Yeah, and also we know that it's going to take a few weeks for WHO, World Health Organization, to figure out the severity of this new strain. So you know, I do expect for the next 2 to 3 weeks, as we come to the close of this month, well, today is the close of the month, and we're going into December tomorrow, and that's the final sort of month for the year. And we're seeing for the next 2 to 3 weeks, it's not, I don't think it's going to be a Santa rally. I really don't believe that we're going to see generally what we tend to see at the end of the year is a bit of optimism, Santa rally, sort of, you know, closing equities and sort of highs. I don't believe that's going to happen in this case now. It's going to take a couple of weeks for us to learn more about this new strain, and therefore I expect volatility based on anything, right? Like I've just said earlier, we had the CEO of Moderna come out stating that, you know, this isn't. Let me just have a look. Where did I'm just trying a quick glance of what I just said. What was specifically said? Okay, so yeah, so even though yesterday we had a bit of a recovery, right? But that was short-lived, as mentioned already. As you know, this morning markets seem to open, and it has proven that, right? It's open with more concern, more risk in the markets, and the market seems to be worried with this new Omicron sort of variant. And the reason being is that it could evade vaccines, as the CEO of Moderna predicts that existing vaccines will struggle against this new variant. Okay, so it's going to take that you know, scientific community a couple of weeks to really establish key levels of evidence that they can provide us. But for now, what we do have is from yesterday. The reason why I was a little bit more optimistic is because, well, firstly, we did have, just lost my train of thought, Biden, so US President Biden, who came out in a very positive manner, right? So, he gave a very optimistic view of what's taken place, okay? So that's the first key point, okay? So his view was that, okay, it's not a cause for panic. That's what he came out and defined as his key sentence from that speech, okay? And they're making very little changes. Federal Reserve Chair Jerome Powell, who we spoke about a little bit earlier, again, he also mentioned that there might be, they're going to look at this, there could be a slower recovery, with the US economy, the labor market, there could be continuation of this heightened sort of inflation scenario. But we're just going to monitor what's taking place. And he's due to speak today as well this afternoon at the Senate. So yeah, that's the sort of the key concern there. So now, what would you do? So what are the sort of the three key points that we could take away as a long-term investor or a portfolio manager adjusting and managing their own portfolio or Alpha Chain's portfolio? Well, the first thing is I would suggest rebalancing by taking some profits from overweighted shares and buying underweighted shares. Okay, so basically what you're trying to do is any assets that you've allocated a certain percentage to, if they are much greater than the percentage you've defined, you might want to bring them back into that percentage that you've initially outlined. And then any asset that shares that you've bought that is underweight, so it's less percentage than you had defined, and because it's losing, right? It's not moving in a positive direction. Those are the assets you might want to buy. So what you're trying to do is any asset that's made some profit, you're taking some of that profit, you're allocating to assets. It's into assets that have maybe overreacted or underweighted or sold off more. So you're adding more. And bringing them in line with the correct portfolio percentages that you want to maintain. Now, by doing that, it's almost a value trade, right? So what you're doing is you're buying assets that are undervalued, right? And you're selling anything that's been overvalued. That's another way of seeing that. Okay, so that's one option that you have. The second is when Friday was also Black Friday, and it wasn't Black Friday buying goods and whatever you may have bought out there. It was Black Friday in the stock market as well. You could see that as markets have been discounted, right? So anything that was on your watch list that you had your eye on that you're looking to buy, you want to buy them at the lowest price possible. Maybe that was an opportunity to buy them in at that lower price. Okay, so that's so if you had a cash to spare and you were looking to buy a particular asset, you're just waiting for a better price, Friday would have been a better opportunity to buy that asset. And lastly, consider the diversification of your portfolio and how it fared in the panic. That's such an important point. Look at your portfolio and look at it the day before or a few days before or at the beginning of the week, and look at it at the end of the week. What was the percentage difference overall in the portfolio? Which assets did really well, which assets did really poorly? And really sort of work out, okay, how can I minimize if there is a large difference in the P&L from the beginning of the week compared to the end of the week. And that's where you could maybe sort of look to, as you're aware of now, that this COVID and this new variant is not going away. We're only starting to explore this. So therefore, I would look to allocate maybe a small percentage of my portfolio to maybe the healthcare sector, right, which showed outperformance on Friday's session. By having that, maybe that might minimize my overall P&L if we have another similar reaction as Friday. So that's another option that you have there. And so those three key points are pivotal for your development as a trader. Now, I'm just having a sort of quick look through the few questions. This is daily basis stock exchange price. Not sure what that's referring to, Mohammed, but we can touch on that a little bit later. So graphs we'll go through later. DCA, dollar cost averaging. Well, dollar cost averaging is very specific, right? Which means that you define a certain amount that you're looking to buy a particular asset on a given period, right? That's what that dollar cost averaging is. It doesn't take into consideration of what market conditions are and the environment we're in, right? So generally, if you say on the first of each month, I'm looking to buy $100 worth of Bitcoin, right? And then over the long term, the hope is that, you know, when prices are sometimes high, sometimes low, that you've averaged your price in, right? So you got to an average price, not just bought the prices at the high side. That's the idea there. So that's a strategy that every portfolio manager should have as part of their management of their portfolio, full stop, no matter what. But this is just covering, you know, what we could take away from what had taken place on Thursday and Friday, was particularly Friday. Yeah. Just a quick look at my positions, guys. Okay, cool. Right. I may have taken a little bit more time on this, but hopefully you've got a good insight. You know, this is great information here, which, you know, we can explore and we can sort of discuss how to better manage ourselves going forward. And this is something that I noted in my portfolio, that hang on, I'm massively underweight to the healthcare sector, and that's something that I'm looking to now build up on within my portfolio, because if there's further risk going forward, for sure, I know that the healthcare is going to actually do okay. Maybe that will reduce my overall, you know, volatility in the P&L of my portfolio. Okay, looking at the sort of year-to-date assets, this was taken on Sunday. Bitcoin's around 97.8%. It's funny how Bitcoin also and all other crypto assets had sold off in the panic as well. So every asset had sold off. And, you know, bond has been lackluster, not a lot of demand for it, but it had outperformed. So the gold's been pretty poor year to date, but we saw gold also do well on Friday's sort of, you know, panic sell. So having your portfolio, you know, with a small percentage to gold and bonds is an important factor as a hedge to those types of environments. But you don't want them to be too large either, because over the very long term, they don't perform well. Simple as, and you can see that here. Okay, so we did see Bitcoin sort of, you know, go down substantially. Bitcoin's now at 57,146 or 40. Now, if we go back to last week, say Wednesday, and look at the price of where Bitcoin was at last week, Wednesday, around the 57,000 mark as well, you know, since the sell-off and now where we are, we've actually recovered. By Sunday, it had recovered back up to around the 57.5 figure. Okay, so, you know, it's just, if you're looking at the weekly number of weekly percentage sort of, you know, difference of Bitcoin, not much of a difference. Intra-week sort of volatility, you could call that. But Bitcoin's still at 97.8%. Oil has retraced, you know, it's back down to 61.8%. Commodities at 50.8%. Stocks have gained, but we've lost a little bit of track most recently. So I believe if I compare that to, let me just have a look if I've got the prior week here as well. Where is it? Yeah, so stocks were in the previous week was up 19.1%. It's now up 18%. Looking at dollar was up last week 6.6%. It's up 7.3%. Okay, looking at investment grade bonds. Investment grade bonds down 4%. It was also down 3.6%. Government bonds around the 7% mark. Not much change there either, to be honest. Okay, so that gives you sort of a quick overview of where assets are. Now, this was something that I had sourced on the Goldman Sachs Global Investment Research platform. So, you know, everything's about scenarios, right? There is no, you know, all-in situation. Okay, you just got to assess each theme, define the scenarios, and allocate the right probability to those scenarios, and then allocate the risk associated with that probability. Simple as that. If you are, you know, a trader who says, no, this trade is going to go in my favor 100%, right? It's going to go 100% in my favor. I'm going all in. Well, that's just a gamble. That's just goes in your favor. That's luck, right? So don't be that guy. Don't be that guy. Don't be that person who, you know, who assumes you know the markets. Even Goldman Sachs doesn't assume they know the markets. They can call out, they give out calls, right? A number of banks recently, Bank of America, Credit Suisse, have mentioned that the oil price will reach $100 by the end of this year, and we're coming close to the end of the year, and it's now retraced substantially from where it was a few months ago, right? So the idea is form ideas, right? From the scenario at current or the current theme. You need to work out a few different scenarios. Based on the scenarios, you assess the probability of it, and then you allocate the right percentage based on which one you're going to go with. Okay. And this just gives you sort of, what's the downside, severe downside, false alarm, and the upside view with this new variant. Okay, this new variant, and also its impact with inflation and growth. Right. So just be mindful of the ongoing rhetoric that comes out and how that's going to lead to further volatility. But you also need to look at the longer term sort of, view of the implications to certain assets as well. Okay. Goldman Sachs analysts are often wrong in their scenario. Yeah, I mean, I don't know. Goldman Sachs is one of the largest banks in the world, institutional banks in the world. They've had some great calls, right? They've taken some fantastic trades that I've seen in the past. There is a website called EFX Plus, which shows where all the banks are positioned, but you need a premium account to gain access to that. We're not saying take their ideas, and we say that from day one, right? You've undergone the training, you've been given access to funds, you have received ongoing mentorship. You should now be able to sort of develop your own trading ideas. The idea is that you want the view of the markets as well. Okay, so use the view of the markets as, does it coincide with what you see in the markets from a fundamental, from a technical perspective? What are the scenarios that you forecast? And then you can position yourself accordingly. Right. Like I said, there's no wrong or right, really, if you think about it, right? It's all about position sizing. Because a lot of traders, what they'll do is they'll give you a big forecast that always going to get to 100. They'll take a trade at 60, get to about 70, 75. The views change based on incoming news. Therefore, they reduce their target levels, or they start to take some profits and book their profits off the table and reduce their exposure. Look at a different asset. What's that view? And then that's how they go about things, right? So it's not a wrong or right situation. It's all about risk management, portfolio management. Okay, now prior to Friday sell-off and with its new variant coming to light, you could see sort of the blue defines what was the likelihood of a rate hike occurring going forward, right? So, how many rate hikes will there be in 2022? So you can see how the Fed were expecting sort of, a rate hike of close enough to about 70 basis points. The Bank of England, a little bit more aggressive, over 100 basis points. ECB potentially one rate hike of a very small, percentage, 0.15% or something like that, 0.1% even. But that's all changed post-Friday. Okay, so that's all changed post-Friday. So now it's been priced into market, so you can quite clearly see based on the yields that we're seeing, overall the markets are viewing that the likelihood of further hawkishness to take place is being reduced. So much so we've had the RBNZ who had raised rates twice, who have stated now, if we start to see cases in New Zealand and we see further risk in this, we will not raise rates. They've already made that very clear there. So yeah, you've got to be mindful now when it comes to the rate path given going forward. Now, all of that's gone out the window. All of that's now changed. And that's why it's important you take this incoming information and see, is it leading us closer to a rate hike or away from a rate hike, or tapering sort of from a Fed standpoint. Some data from yesterday. Inflation is still around. Inflation hasn't gone anywhere. It's taken number 2 in regards to the importance from a financial markets perspective, right? So number 1 is obviously this new strain, and that's what everyone's going to be talking about. But number 2 is still inflation, which was originally number 1 in focus. So yeah, inflation in Germany came out yesterday, accelerated to 6% in November. Okay, so not great, not great. Okay, you know, the Euro bloc are there's going to be given the least indication of a rate hike, but yet they're going through a lot of strong inflationary period right now, and especially with one of their strongest economically driven countries within the Euro bloc, Germany, being impacted by a substantial amount of inflation numbers. It's 6%, pretty much in line with the US now. Okay, and moving on from there, something on the to talk about, sort of to end on this session, right? With yeah, S&P 500s really sort of moving lower now, guys. Just looking at the day time frame, it's pulled back substantially now. Okay, so this is Microsoft's share price, right? And it's a multi-year view. This is taking it back from 1997, right? So you can see the dot-com bubble, right? The dot-com bubble somewhere in this region here. And then you can see sort of the 2008, which has not been identified, it's not been sort of highlighted, but 2008 sort of crash had taken place here, where the markets had sold off substantially. But since that point, have a look at the share price, right? So have a look at the share price, the growth, the exponential growth. You say, you know, will Bitcoin continue to rise, right? When you're looking at a share price of Microsoft, right? You know, and that's been going on for multiple years since 2015, if you want to take it on board. Right, so nothing further to say there, right? So, okay, so Nadella, who is the CEO, he was instated, you know, somewhere between sort of 2014, early 2015 potentially. So 2014, I'll say. Since he's stepped in, he has, it's been filed just recently that he has dumped 50% of his stocks, of his shares that he owns in Microsoft. So he's sold 50%, which is a lot, right? Considering that Elon Musk has been doing it recently. I believe Jeff Bezos has reduced, has taken some of his, sold some of his shares, but Elon Musk, you know, made it very open. Okay, he did a Twitter poll, but prior to the Twitter poll, he did sell some already. So he was always going to sell. He just did a Twitter poll just to sort of, you know, be that type of person, right? As he is, everything's out there. So, you know, he's defined that he's going to look to sort of sell 10%. But, you know, now we've got Microsoft CEO Nadella dumping 50% of his shares, right? Now, the reason I can understand from Elon Musk's perspective, the reason, and he's mentioned this in one of his presses, in one of his interviews, the reason behind this was is because it suggests that Washington State's imposition of a 7% tax on long-term capital gains is starting next year. Okay, so that's one of the potential reasons that they've declared that, you know, we're seeing these billionaires starting to sort of sell their own stocks, their own shares of companies that they own or that they run. But it still doesn't make sense to me. Still doesn't make sense to me because, you know, it's a 7% tax. It's a 7% tax. And so I can understand now Elon Musk has taken 10%. So he's got a 3% for himself, 7% potential for the tax, right? But setting off 50%, wow, that's a big stance. That's a big stance, right? Now, you've got to also remember that, okay, you get 7% tax, right? But reducing your, you know, taking 50% off the table, you're minimizing the growth as well, right? So your view is that, okay, you know, maybe the Microsoft is not actually going to continue to move any higher. I'll take 50% now. If it sells off, I'll start buying more shares at those lower prices. In the meantime, I might just go to, you know, something safe like bonds and get a few percent coming through, and then also then I can clear this tax when this applies. So that's the view there. You know, is that it's a big deal when someone pretty much dumps half their stake in a company that they are running. From, you know, and him being an insider, he should know that there may be further reasons for him to know that there might not be further gains with Microsoft. So yeah, that's something to sort of, you know, mention there in regards to something that I reviewed, I believe, yesterday. But yeah, that brings us to the end of this presentation.